keep it going. Let's keep it going this afternoon here. Second half. All right. Modernisation of payments. Now, this is going to impact our insurers, but how? You might be wondering. So strap yourself in. We are going to learn more about efficiency, customer experience, and so much more with the Chief Commercial Officer from Monoova. Make some noise for David Greene.
What an intro. All right. Perfect. So according to PwC, over 30% of your finance team's time is spent on manual reconciliation. Deloitte says that this costs Australian businesses as much as $2 billion each year in lost efficiency. Good afternoon, ladies and gentlemen. My name is David Greene, and I am the Chief Commercial Officer of Monoova. And it's a pleasure to be here today to talk to you about something that is fundamental to the insurance industry, but often overlooked: payments. Payments are the lifeblood of the insurance industry. Whether it's collecting premiums, settling claims, issuing refunds, the ability to move money quickly, securely, and efficiently directly impacts the experience of policyholders, operational costs, and ultimately competitiveness. As we'll talk about shortly, the Australian government is modernising Australia's payment system. This modernisation is and will continue to be significant. Thus, we stand at a pivotal moment. Change is coming, and insurers, like all industry participants, must be ready to adapt. Today, I want to explore what this transformation means for the industry, the impact similar changes and reforms have had in other markets, and what steps are needed to stay ahead of the curve. But to understand what's ahead, we first need to look at the broader picture of payments transformation. Here in Australia, we've seen a significant push towards digital-first payments. The introduction of the new payments platform, or intelligently phrased NPP, back in 2018, laid the groundwork for real-time transactions. And now, with the rise of real-time account-to-account capability, we're moving towards a world where payments are instant, data-rich, and more secure, all whilst maintaining a comparatively low cost base. The government's announcement signals further changes. We've got Payday Super proposed to roll out in July 2026. We've had significant news and media around proposed surcharging reforms specific to card payments. The big one is the phase-out of the deprecation of the legacy systems like BECS by 2030. There's a greater adoption of real-time payment rails and more stringent security and compliance requirements in order to combat fraud. To understand the potential impact, let's look at other countries that have modernised their payments infrastructure. So in the UK, they have the Faster Payment System, or FPS. So the introduction of real-time payments in 2008 not only transformed money movement within the UK, but it also helped transform insurance claims. Instead of waiting days for a payout, claimants would receive funds instantly, improving customer satisfaction and also reducing operational delays. In India, with the Unified Payments Interface, or UPI, digital payments exploded from the launch of this back in 2016, with adoption rates rising exponentially to almost 50% of total instant global bank-to-bank payments by 2022. Insurers launched to innovate instant premium collections as well as micro-insurance products which expanded financial inclusion, a key goal of the UPI initiative. And in Singapore, we have Pay Now Corporate, where insurers leverage real-time bank transfers by utilising the unique entity number, or UEN, which acts in a similar construct to our own PayID format, to streamline both collections as well as disbursements. This all but eliminated manual reconciliation processes and significantly reduced costs once it was enabled in 2018. So these examples highlight one key trend. When bank payments become faster, more intelligent, every stakeholder, from consumers to insurers to merchants, benefit. Equally at home, there are adjacent industries which are tackling structural changes, or which will have to tackle structural changes due to these reforms. And specifically, we're talking about superannuation and, by extension, payroll in the form of payday super. As I said up front, it's slated for July 2026, but at a higher level, superannuation contributions have to flow at the same time as payroll, rather than accrue and be paid no less frequently than quarterly. Transaction volumes are expected to triple to over 500 million contributions per year, whilst failure rates are forecasted to remain consistent at 1.6%, there or thereabouts. The remediation time for super funds and super administration platforms is proposed to reduce from 20 business days to 7 calendar days. Just that throughput alone means really the industry has two options. One, throw more bodies at it, or two, innovate with technology. And actually, the existing infrastructure will struggle to support this. Thus, compliance for industry participants can only come with the adoption of the MPP. So what does this mean for Australian insurers? There are four main areas where payment modernisation will have a direct impact. One, probably the most obvious and the one that's in market, but that's faster claims processing. So insurance claims are one of the most critical consumer touchpoints. Traditionally, payouts would take 3 to 5 days to process. With real-time payments, this can be eliminated immediately. For things like emergency payments, this is critical. Second, we move on to lower costs and greater efficiency. So, rather complex slide, excuse me, but I'll work my way through it. But the common myth is that the legacy BEX payments, so direct debit or direct entry, direct credit, etc., are free or low cost. This may be true when only considering the direct transaction cost, but cheap doesn't always mean better, a phrase that I hope many of us in this room can align with. So much like the iceberg analogy, legacy payment systems come with a cheap upfront cost or direct cost, but high operational costs, whether it's through check processing, manual reconciliation, misallocation of funds, fraud-related costs, batch processing, never mind the impact on consumer experience, the CSAT scores, when an unallocated premium payment doesn't get reconciled and the insurance doesn't trigger, or worse, it expires. BPay does solve for this, but it's slow and it's expensive, especially when compared to its MPP PayID counterpart. Using our proprietary automated reconciliation rules, industry participants in adjacent industries such as lending, utilities and remittance, as an example, all automate reconciliation and also automate a resulting refund from, let's say, an overpayment or automate the request for balance from an underpayment, all without manual intervention from an operations team or a customer success team. The customer, as well as the merchant, are updated instantly by leveraging real-time notifications. Thirdly, improvement in customer and merchant experience. Today's consumers expect frictionless payment experiences, thanks in part to the likes of what you would have with Uber. But whether it's policyholders wanting flexible premium payment options or it's merchants needing instant refunds, the modernisation of payments allows insurers to meet these expectations. Pay2, for example, enables direct debit transactions to be instant, more reliable, and provide greater control to policyholders. And lastly, enhance fraud and data insights. So with this payment modernisation comes the ability to leverage a much richer data asset for things like fraud detection. Enhancements such as confirmation of payee, coming later this year, mean that the customer account details can be verified and then whitelisted. This results in complete transparency and trust when, say, a claim payment is being made back to the premium holder's bank account. So while the benefits are clear, there are critical considerations insurers must address to successfully transition. One, technology investment. Payment modernisation requires a robust API-ready infrastructure. Big technical projects, specifically, especially on payment side, can quite often be long and expensive. And not just from a CapEx perspective, but also from a resource and time and institutional focus. But they ultimately they require large investment of money. To build the business case, what we find helps is where the implementation is phased. And by this I mean isolate the quick wins, the low-hanging fruit. Build test and pilot programs that can be stood up efficiently. They solve a real business problem, but in a way that doesn't impact core infrastructure. The second one is around change management. Transitioning to new payment systems is not just a technology shift. It requires process re-engineering, it requires employee training, and it definitely requires customer education. And thirdly, customer-centric innovation. So rather than seeing payment modernisation as just a compliance exercise or something that needs to be done by 2030, insurers, like other participants in adjacent industries, should look to leverage it as a differentiator. Insurers that provide seamless, real-time payment experiences will gain a competitive edge. And this modernisation isn't just isolated to insurance. It's something that all industries have to navigate. Every vertical will have to adapt. Importantly, payment optionality isn't the only advantage to be had for the industry. The customer experience as a result of automated reconciliation, as an example, will delight your policyholders. So the modernisation of Australia's payment system is not just a regulatory change. It's an opportunity to redefine how we engage with customers, optimise operations, and future-proof our businesses. The insurance industry has often lagged behind in adopting payment innovations, but that can change. If we embrace real-time, data-driven payments, we can create a more efficient, customer-friendly, and secure ecosystem. So, I'll leave you with this question. Are we ready to transform the way we handle payments? Because in this new era of digital finance, those who adapt early will lead the market. Thank you.
Thank you, David. Crack open your app, plenty of time for Q&A. I've got a bit of a question, looking at insurers in general, right, in particular. Where do you think the help is needed most with payments? Is it claims? I mean, we saw from AFCA looking at those complaint categories, I think 91% of that 30,000 was claims and the other 8% was couldn't get the right information from memory. Where do you think insurers need help? Is it the payment of claims? Is it direct debits for premiums? What are your thoughts on that?
You know, I mean, just spending time out in the foyer and listening to some of the pain points that a lot of you have, there's a couple of things. Claim payouts, probably, I don't necessarily think that that's where the issue lies. Certainly the reconciliation piece is a big bugbear, and it's more because of it feels like the operational impact that has. And then I think there is maybe a somewhat of a hesitation to look at new innovative mechanisms because it requires kind of broad institutional change. Yeah. And so sticking to something that currently works, if it's not broken, then don't fix it. Probably, I think that's the other impediment to moving forward or moving along with the innovation.
Yeah. It's interesting, isn't it, the reconciliation? I know you had the slide up there, David, that said, the request was 100, the payment was 110, the request was 100, or the payment was 90 and the request was 100. And it is that real difference, isn't it, between failing a payment or taking what you've got and remitting the rest back. Is that as easy as it seems to implement that sort of framework where we can take the 90 and then request another 10?
Yeah. Come and chat to us. We're over in the foyer out there. But I'm very conscious of staying in my lane, and when we get into technical APIs, then that's probably an area that I'm a little bit dangerous. It's dangerous for me. But yeah, like I think in terms of if there is a customer experience that you want to have, then 100% that's easy. Yeah.
And final question, we mentioned the journey that insurers are on, the opportunity that this payment revolution represents. Who's doing it well outside of insurance? Where do you see the most progress in this payments space?
I think like those businesses that are digitally native are really accelerating. So, we're seeing a lot of adoption in the wealth space, seeing a huge amount of adoption in crypto. But any investment platforms, like we talked to quite a lot of investment platforms. We're seeing lending utilise the likes of Pay2 really effectively. Just the cost of capital improvements that they have by using Pay2 agreement to instantly pull funds, cleared funds, from a borrower's bank account into theirs. A direct debit will typically take 2 days to settle, whereas Pay2 happens in 2.3 seconds. So if you're a big lender and you have a warehouse facility that has interest that you need to pay out, the sooner you can get funds in to offset that payout, obviously the better, much more effective economics that you'll have. So lenders take up a lot on it. And we also see rental in the property market. So automating and managing real-time collection of rental payments. And then dispersing out to landlords, all of that, sort of like the end-to-end flow. They do it quite well too.
Yeah, compressing that cash flow by a few days is massive, as you say, when you're running a wholesale facility. And you're not one of the big four who's got a few dollars to spare.
Probably I think in terms of the biggest kind of existential threat to a specific industry would be superannuation and payroll. With the impending payday super, there's a lot of superannuation. That whole industry is kind of sitting there thinking, oh my God, I don't actually know how we are going to change everything in order to kind of meet our regulatory requirements. So they'll have to throw a lot of bodies at it, but they'll also, importantly, look to innovate. That only benefits us as superannuation members. So it benefits everyone, but there's a decent shift in kind of what is happening now versus what it needs to.
13x, right? Like I pay my super quarterly for my company. Yeah. Quarterly, once 4 times a year versus 52 times a year when I take a wage each week. It's 13x, and that's one person.
Yeah, that's right.
There's 10 million Australians, so that's
a
lot of volume.
So the only way to solve that problem is through technology, and we're happy to chat with any of you that want to go on that journey.
For those that don't want to throw bodies at the problem, have a chat to Monoova. Please thank David Greene.
Thank you.
Thanks.